This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 29, 2026, and this is the Tokyo session. Now, let's get into it. Gold is sitting at $4,022, holding its ground despite a fear and greed index at 14. That is extreme fear. Yet, the dollar remains stubbornly strong against the yen, and the pound is consolidating near key technical levels. The market isn't just waiting for the Fed's rate decision today at 2 o'clock Eastern, it's bracing for it. With geopolitical tensions in the Middle East flaring and the Bank of Japan's decision looming tomorrow, volatility is the only certainty. Let's see what the data is actually showing right now. The calendar is packed. The big one, obviously, is the Federal Open Market Committee's rate decision. That lands today, Wednesday, July 29th, at 2 o'clock Eastern. The current target range is 3.5 to 3.75%. Every basis point here matters.
And what happens after the statement is equally important. The tone of the press conference will set the trajectory for the week.
Right. Then moving into tomorrow, Thursday, July 30th, we have the Bank of Japan's rate decision at 3 o'clock Eastern Tokyo time, which translates to early morning for us here. That's going to shake up the yen crosses immediately. Also on Thursday, we get the ISM Manufacturing PMI and the Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge. Finally, Friday, August 1st, brings the Employment Cost Index. But for now, the eyes are on the FOMC. Apex, before we dive into the pairs, what's the overarching setup for this session?
It's a classic wait-and-see environment. The FOMC decision is the anchor, but you have the BOJ decision tomorrow adding a secondary shockwave. The market is currently pricing in a high probability of a hold, but the risk is on the guidance. If the Fed stays hawkish, the dollar strengthens. If they pivot, we see a quick repricing of rates. The key is to watch the reaction to the dot plot, not just the headline number.
Let's look at the board. The euro is trading at 1.1398, up 0.1%. The pound sterling is at 1.3296, also slightly positive. The dollar yen is at 163.59, down a fraction. The dollar Swiss franc is at 0.8178, down 0.2%. Gold is at 4,022, down a tiny 0.06%. The VIX closed at 18.67 yesterday, indicating volatility is elevated but not in panic mode yet. The fear and greed index is at 14. That is deep in fearful territory. On the news front, headlines are dominated by geopolitical risk. Trump stated that the U.S. will be hitting Iran hard in reaction to attacks on U.S. forces in Jordan. Meanwhile, oil climbs as Iran rejects an Oman proposal on the Strait of Hormuz. And in the U.K., mortgage approvals rebounded in June, but credit data continues to point to worrying signals in the broader economy. The UK mortgage data is a classic divergence. The headline number looks okay, but the credit conditions are tightening. That suggests the Bank of England might need to stay higher for longer to combat stickiness, even if growth is slowing. It's a stagflationary hint.
And the Iran news. That's the elephant in the room. Gold isn't rallying as hard as you'd expect given the headlines. That tells me the dollar strength is currently overpowering the safe haven bid.
Let's move to our first priority ticker, the euro dollar. It is consolidating right at the key 1.14 resistance level. Grid, the chart is waiting for a decision. What do you see? The euro is at 1.1398, just below the 1.14 handle. Grid, walk us through the structure.
It's a tight consolidation. Look at the 5-day range. The high was 1.1418 on Tuesday and the low was 1.1353. Today we're sitting at 1.1398. The price action is compressing. We had a clean breakout attempt on Tuesday that failed, leaving us with a bearish engulfing candle on the daily. The structure is weak. I'm watching 1.1353. If that breaks, we're looking at a retest of 1.1320, but right now it's stuck in this box. The volume isn't expanding. It's a low-convenience range-bound setup.
The positioning confirms the hesitation. In the latest COT data, leveraged funds are strongly bullish on the euro, with a net long position of 1,209 contracts, and they added 1,363 contracts week over week. That's a lot of positioning built into this consolidation. But look at the asset managers, they are net short, negative 3,290 contracts. So, the smart money on the long side is leveraged funds chasing the breakout, while the institutional managers are hedging or shorting the top. This is a fragile setup. If the FOMC comes out hawkish, those leveraged longs are going to get squeezed.
And the macro context isn't helping the euro break higher. The US 2-year yield is at 4.31%, and the 10-year is at 4.65%. The spread is positive, but the US economy is showing resilience. Real GDP is at 2.09%, and the unemployment rate is a healthy 4.2%. Inflation, measured by core PCE, is at 3.41%, which is still well above the Fed's 2% target. That gives the Fed room to hold rates steady or even hint at further hikes if needed. The euro doesn't have that same growth momentum right now.
Here's the risk nobody is talking about. The VIX closed at 18.67 yesterday. That's elevated, but it's not panic. However, the term structure of volatility is in contango, with the VIX 3-month futures at a premium of 0.94 to the spot VIX. That means the market is pricing in more volatility later, not less. If the FOMC statement is ambiguous, that volatility could spike instantly, and with the euro stuck at resistance, a sudden spike in volatility could see the euro break down below 1.1353 very quickly. It's a trap for the bulls.
So, grid, you see a technical squeeze, CIPHER confirms the leveraged positioning is vulnerable, and SPECTER warns of a volatility spike. Apex, how does this fit into the broader picture?
It fits perfectly. The euro is caught in a vice. Technically, it's at resistance. Fundamentally, the US yields are competitive, and positionally, the longs are crowded. The FOMC decision today is the trigger. If the Fed doesn't give a dovish hint, the euro will likely reject at 1.14 and slide toward 1.1353.
Let's talk about gold. It's at $4,022. Despite the Iran tensions, it's down on the day. SPECTER, this is your domain. Why isn't gold rallying?
It's the real yield. Look at the 10-year Treasury yield at 4.65%. Gold pays zero yield. When real yields are this high, gold struggles. The geopolitical risk is a secondary factor right now. The primary factor is the dollar. The dollar index is strong and the U.S. economy is showing strength. Gold is being sold into strength. It's not a safe haven play right now, it's a liquidity play. And in a risk-off environment, traders are selling gold to raise cash.
Technically, the chart is bearish. The 5-day high was 4,116.48. Today, we're at 4,022. That's a significant drop from the high. We're testing the 5-day low of 4,010.41. If that level breaks, we're looking at a move down to 4,000. The structure is lower highs on the intraday charts. It's weak.
The COT data for gold shows leveraged funds are strongly bearish, with a net short position of negative 540 contracts, and they added another 540 contracts last week. That's a massive shift. Smart money is shorting gold. They're not buying the dip. They're betting on further declines.
And the inflation data supports the bearish view on gold. Core PCE is at 3.41%. That's high. The Fed will keep rates higher for longer to fight that. Higher rates for longer is bad for gold. So the consensus on gold is bearish. SPECTER, you're the contrarian. Are you seeing anything that could flip this?
I'm not seeing a flip yet. The only way gold flips is if the Fed signals a cut, which would crush the dollar and real yields. But given the inflation data, that's a low probability scenario. The bearish view is the one with the data to back it up right now.
Correct. The gold trade is crowded on the short side, which always carries risk, but the macro and technicals are aligned against it. I'm staying on the sidelines until we see a clear break above 4,100 or a breakdown below 4,000.
Next, dollar yen. It's at 163.59. Grid, what's the technical setup?
It's strong. We're trading near the 5-day high of 163.95. The price action is making higher highs on the intraday charts. The structure is bullish. I'm watching 163.30 as support. If that holds, we're looking at a test of the 163.95 high. The trend is up.
The COT data is overwhelmingly bullish for the dollar. Leveraged funds have a net long position of 1,209 contracts, and they added 197,394 contracts week over week. That is a massive influx of capital into the long dollar-yen position. The smart money is betting on dollar strength.
The macro context supports this. The U.S. two-year yield is at 4.31%, while the Japanese yield is near zero. The carry trade is alive and well. As long as the BOJ doesn't hike, the dollar-yen will remain attractive.
But here's the risk. The BOJ decision is tomorrow. If they hint at a rate hike or intervene in the currency market, the dollar-yen could crash. 163 is a level where Japan has intervened before. The positioning is extremely crowded. If the BOJ surprises, those leveraged longs are going to get stopped out in a flash.
So the trend is up, but the risk is a sudden BOJ intervention. Apex, how do we play this?
We don't play it, we watch it. The trend is up, but the risk/reward is poor right before the BOJ decision. The best play is to wait for the dust to settle. If the BOJ stays dovish, the dollar-yen will likely test 164. If they hike or intervene, we'll see a sharp drop. The data doesn't favor a directional trade right now.
Finally, the pound sterling. It's at 1.3296. Grid, the chart.
It's range-bound. The 5-day range is 1.3273 to 1.3363. Today, we're at 1.3296, right in the middle. The price action is choppy. There's no clear breakout. I'm watching 1.3273 as support. If that breaks, we're looking at a move down to 1.3250.
The COT data shows leveraged funds are neutral, with a net position of negative 154 contracts, but asset managers are net long, with a position of positive 16,284 contracts. So, the long-term money is long, but the short-term traders are neutral. This suggests a lack of momentum.
The UK mortgage data is mixed. Approvals rebounded, but credit conditions are tightening. That's a drag on the economy. The Bank of England might need to cut rates sooner than the Fed to support growth. That's a headwind for the pound.
The risk here is a general risk-off move. If the stock market sells off, the pound will likely follow. It's a high-beta currency. If the VIX spikes, the pound will fall.
So the pound is stuck. Technically range-bound, fundamentally mixed, and positionally neutral. The FOMC decision will likely drive the dollar strength, which will weigh on the pound. I'm watching for a break below 1.3273.
To summarize, the euro is stuck at resistance, vulnerable to a hawkish FOMC. Gold is under pressure from high real yields and bearish positioning. Dollar-yen is strong but faces BOJ intervention risk, and the pound is range-bound with mixed macro data. The key for the rest of the week is to watch the FOMC statement and the BOJ decision. Don't chase the breakout. Wait for the confirmation. It's time for our weekly calls. Let's start with the euro-dollar. The macro data shows U.S. resilience, and the Fed is likely to hold rates steady with a hawkish tone. The euro doesn't have the momentum to break above 1.14. My call, euro-dollar bearish, target 1.1320 by Friday.
Technically, the euro is at resistance with a bearish daily candle. The support at 1.1353 is weak. I expect a breakdown. My call, euro-dollar bearish, target 1.1310 by Friday.
Leveraged funds are long, but asset managers are short. The FOMC will likely trigger a squeeze on the longs. My call, euro-dollar bearish, target 1.1330 by Friday.
The VIX term structure is in contango, signaling more volatility. The euro is overextended. My call, euro-dollar bearish, target 1.1300 by Friday.
The consensus is clear. The euro is under pressure. My call, euro-dollar bearish, target 1.1320 by Friday.
Now gold. Real yields are high and the Fed is hawkish. Gold has no tailwind. My call, gold bearish, target 3,950 by Friday.
The chart is making lower highs. The support at 4,000 is critical. My call, gold bearish, target 3,980 by Friday.
Leveraged funds are strongly bearish. The smart money is shorting gold. My call, gold bearish, target 3,970 by Friday.
The carry trade is strong and gold pays nothing. My call, gold bearish, target 3,960 by Friday.
The data is aligned against gold. My call, gold bearish, target 3,950 by Friday.
Thank you for listening to ShadowQuant. If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Forex trading carries significant risk of loss. Always do your own research before making any trading decisions. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the London session, where we will see how these calls play out. Until then, trade safe.